Okay, so now this is the financial focus portion of our weekly webinar. And in this portion, we're going to talk about RMDs and Roth conversion, rules you have to know if you're over 73 years old, or if you happen to be listening to this in several years, if you're over 75 years old, and you're required to take required minimum distributions, and you're embarking on Roth conversions. Now, I hate to tell you, if you're taking required minimum distributions out of an inherited IRA, you can skip this video because you can't do Roth conversions from an inherited IRA under the current rules we have today. So I hope that changes for us, because that's an issue. I don't think it will, but who the heck knows? Maybe. But from a traditional IRA to a Roth IRA, there are, if you're doing this conversion process and you're taking distributions via required minimum distributions from your traditional IRA, you don't want to have any missteps. Now, let's first give some fundamentals here. So I'm going to share my whiteboard here, and you're going to see me looking down. But first, we're going to talk about Roth conversions. So again, fundamentals. So let's talk about Roth conversions. So what is a Roth conversion? So we've got our buckets here, and you all heard this before, or maybe you're brand new and this is your first time hearing this, but we know that your money in your taxable bucket produces 1099s every year, sometimes K1s, and you get tax on the funds that generate these 1099s. So that's interest, dividends, long-term capital gains, short-term capital gains, and so on. And you pay tax on that every year. That's why they call it the taxable bucket. So that's for my friend and mentor Ed Slott would say that's forever taxed. Right? Then you also have your tax deferred bucket. So your tax deferred bucket are your IRAs and your 401ks and any kind of retirement plan you have. Now this is also forever taxed, right? Because any money that you take out of this tax deferred bucket, you're going to pay tax on. And the issue is that we don't know what the tax rates are going to be in the future, and most of us believe that they're going to have to be significantly higher than they are today. So if you have the opportunity to pay your tax now at what could be lower tax rates, and save that money in the future, why not take advantage of that? And the tool that we have for that is what we call a Roth conversion. So that a Roth conversion allows us to move money from this point to this point. And this tax advantage bucket is never, so Ed would say, never taxed. And I like the way he does this. You want to move your money from forever taxed to never taxed. Really, it's never taxed again, right? Because once you get your funds over to this side of the ledger, then you don't ever pay tax on it. So we have this tool called Roth conversions, and the IRS the tax rules are very liberal about this. You can convert as little or as much as you'd like. It doesn't matter how much income you have, or if you have any income at all. So you can earn $0 or $1 billion in a year, and you can still convert as much as you like. Let's say you have $1 million in this tax deferred bucket over here. Well, you could in fact convert that entire $1 million in 1 year if you wanted to. The IRS doesn't care. All they want is their tax, the levy here, the cost of moving from this bucket to this bucket. And if you're just listening on the podcast or even on this webinar, if you just got your earbuds in, I'm drawing out obviously on the whiteboard, the movement. But so when I say this bucket to this bucket, I'm talking about the tax deferred bucket to the tax advantage bucket. All you have to pay is that tax. So it's relatively simple. I didn't say it's easy, but it's relatively simple. Now, most people this doesn't work for, right? It doesn't make sense to do all in one move, to take $1 million and move that all over at once. Most people, and what we do for folks is we come up with a schedule with, a mathematically ideal amount that makes sense to convert over every year. And again, that's relatively simple. So if if you broke it down over a 5-year period, let's just some easy math, $200,000 a year adjusted for growth every year, adjusted for increase in marginal tax brackets, you got a pretty simple plan there. But something happened. So if you're under 73 years old, right? So less than 73 years old today, This is a pretty simple approach. Now, let's just say that you start this when you're 70 and you get a couple years done, and then you hit 73 right here in this year. Well, now you've got new rules to pay attention to. Now you have this thing called RMDs. So let's go back to the fundamentals and talk about RMDs, required minimum distributions. All right, so now what I'm hiding here under my picture is this uniform lifetime table. So now if you're 73 years old, we know that you've got to withdraw 3.77% of your investment portfolio. That's in a required minimum distribution, or excuse me, that's in a traditional IRA or your 401k or other retirement plan. You've got to take this required minimum distribution. And if you don't take a required minimum distribution, then you're penalized. And we'll talk about what the penalty is. But the good news is that we're using an easy number here. So we're going to take that $1 million. Where are my buckets over here? We're going to take this $1 million, and if it's still $1 million, it would be $37,700 that you have to take as a required minimum distribution in that year, right? So it's pretty simple. It used to be a little more challenging. We had to do these factors, and that's just dividing. You look at your year-end value. So if your required minimum distribution is due, you use your 12/31/2024 year-end prior year end value, and you figure out, and let's just, again, keep it simple, $1 million. Here you multiply it by 377, right? And that gets you 37,700. Or you divide it by, I don't even know where to do that. Over here. No, that's me. You can't see it. So either that or you divide it by 26.5, and it will give you the same number. But it used to just be that factor, the life expectancy in years, but they've made it easier for everybody now and have done these percentages. So you can download this table from our website. That's attleboroughwealth.com. That's attleboroughwealth.com. Now, I'm going to give you a little warning as we stand here in December 4th, 2024. We are shifting to a new website provider. So I happen to know that download link is a little sketchy right now. What I mean by that is it may not work right. But give it a week or two and you can download it. And if you need this table, and you can't wait a week or two, you can reach out to us at questions@attleboroughwealth.com. That's questions@attleboroughwealth.com, and I'll be happy to send it to you. Well, here's the point though. Let's say now you are 73 years old, and you want to do a $200,000 Roth conversion. Well, that's fine. You can do a $200,000 Roth conversion. But you first have to satisfy this RMD. So that first has to come out. Now, if you were listening during our weekly webinar, we talked about, the first dollars out of a IRA when you're over required minimum distribution age, 73 or above in today's rules. That first dollar out is considered required minimum distribution. So if you try to be cute about it and say, well, I'm going to take out $237,700, but I am going to wait until the end of the year for my RMD. I'm going to do my conversion first, and I'm just going to say that the RMD was. I'm going to say that it was done separately, right? But the IRS is going to look at the distribution, the first distribution, as the RMD. So now what happens is you have a non-allowable conversion into your Roth IRA that you're going to have to unravel. You're going to have to undo that and any earnings that are associated with that. So just avoid that hassle altogether and just realize that, hey, first I've got to take care of my required minimum distribution. So if you're over 73 years old, you have to take required minimum distributions. You actually start, your required beginning date is the April 1st of the year following the year you turn 73. And I think there's some good reasons for that. It gives people an opportunity to realize they may have missed it. Maybe they talk to their tax preparer and they say, hey, you should have taken this RMD, and you have a chance to do it. It's just another confusing rule, that you can push it off until April 1st. Most people don't, and most people shouldn't. But you've got to do these RMDs before your conversion. So it's on here. So let's talk about the penalties if you miss your RMD. So you want to take those RMDs, and I have the penalties right here. And here is the reference. This is right from the IRS website if you want to pull that up yourself. I don't know if you can capture that or not, but so you'll see here if the account owner fails to withdraw the full amount of the RMD by the due date, the owner is subject to an excise tax equal to 25% of the amount not withdrawn for 2023 and later years. The Secure 2.0 Act dropped the excise tax rate from 50% for distributions. Now, I know nobody wants to pay 50% on $37,000, and most of you don't want to pay 25%, or even, you'll see later, it could be 10% penalty on missing these distributions. So just make sure your distributions are done. So they dropped the tax rate or the excise tax rate from 50% for distributions required for 2023 and reduces the tax rate to 10% if the error is corrected within 2 years. The account owner should file Form 5329, additional taxes on qualified plans, including IRAs and other tax-favored accounts, with their federal tax return for the year in which the full amount of the RMD was required but not taken. Now, I'll say that one of the updates we received from the slide group was that the IRS still seems to be forgiving this missed RMDs if you file the correct paperwork and you take your RMDs as soon as you discover it. Now, it's not a blanket statement. They're not going to just give everybody relief on this, but it seems to be that they're still giving relief on missed RMDs. My concern, and many of our concern, was, well, geez, now that they've reduced this from 25% to, from 50% to 25% and then possibly 10%, I don't know if they're going to be giving away the the relief anymore, but they seem to be doing that. So these are the penalties. So you don't want to miss your RMDs. But again, you have this other layer of rules when you have Roth conversions involved. You have to do these RMDs before conversions. Now, we've been doing this. We've been practicing this next item, really for as long as I can remember, this aggregation. But it's really clear now that not only do you have to take the RMD for the account that you're considering doing a conversion in, because in the past people would say, well, if I have $1 million and I have five $200,000 IRAs, again, because people are just sometimes trying to just get around the rules for some reason, or well, I don't know why, but they would say, okay, well, if I've got five $200,000 IRAs and I'm only going to convert this one this year. Now, I have an RMD rule, so RMD due, so I'm only going to take the RMD out of this $200,000, let the other sit in there, and I'll take these later in the year. Not that you can not take them, but take them in later in the year. So I'll take the RMD for before the conversion in this one, and I'll take these later. Now, that's not the practice we've had. We've always said, well, if you have an RMD, I don't care where you take it from, right? So you don't have to necessarily take it from this IRA that you're converting, but you've got to take it from somewhere. So you can aggregate the accounts or the RMD from one account. You could take it all from this one account. This whole $37,700 could come from account number 5 in this example, 1, 2, 3, 4, 5, and convert one. And there might be good reasons to do that. That's exactly what we do in our account segmentation strategy on a regular basis. But the thing is that the entire RMD has to be, now for sure, has to be done before any conversion, not just the amount that applies to this account. I hope that makes sense. So let me just share this. We talked about this in a previous weekly webinar, but I'm going to share it with you again. So Andy refers to this as a new rule, but again, it's what we've been doing in practice. So all our IRA RMDs must be satisfied prior to doing a Roth conversion. And Andy writes, yes, you read that correctly. This rule was confirmed in the 2024 final Secure Act regulations released just this past July. So this is relatively new information. If a person has multiple IRAs, even if they're held at different custodians, the total aggregated IRA required minimum distribution must be withdrawn before any Roth IRA conversion or 60-day rollover can be completed. This does not include RMDs from any work plans like a 401k. There's separate rules for IRAs and 401ks. Aggregation rules tell us that RMDs for each IRA must be calculated separately, but the aggregated total may be taken from any one or more of the person's IRAs. I just explained that to you. The first dollars distributed from an IRA in a year when RMDs are due are considered the RMD. So that's the third time many of you have heard that today. So let me just underline that. The first dollars distributed from an IRA in a year when RMDs are due are considered the RMD. In addition, we know that RMDs cannot be rolled over or converted. RMDs cannot be rolled over or converted. Let's highlight that. That's important. RMDs cannot be rolled over or converted. We get asked that question all the time. Cannot be rolled over or converted. But if you think about it, it'd be kind of silly, right? I think RMDs should be able to be converted because you're paying tax on it, right? You can, if you're able to make Roth contributions. Conversions and contributions are different, and they have different rules. But if you can do a contribution, if you have earned income, and if you don't have too much earned income, the RMD could in fact be used as a contribution, but they cannot be converted. Again, I know these are confusing items. That's why it's important to always educate yourself or work with someone who understands these rules. So ergo, the RMD must be taken prior to any conversion. Sequencing matters. So he's going to give us an example similar to what I just gave you, but in some more detail. So I'll read through it with you. So here's our example. Arnold, age 80, his uniform lifetime factor is 20.2. And he's referring to this table I showed you. Where'd it go? Right here. This is the uniform lifetime table, right? So he's 80. Now he's using this divisor factor, so it's 4.95% of his retirement plan or IRA balances must be distributed. So Arnold, age 80, uniform lifetime factor of 20.2, has 3 IRAs held at 3 different custodians. That is really common, isn't it? People have, I've got something at Vanguard, I got something at Fidelity, I got something at my bank, and you've got to account for all of these. And let me just, another aside, the reason that this is important is scheduling. You know, we do handle a lot of required minimum distributions, and our preference is we like to distribute that RMD on the clients during the client's birth month. So that helps us operationally. So we're not doing them all at the end of the year or all at the beginning of the year. However, but that doesn't always work, does it? Because if somebody has a birthday in June and they want to do a Roth conversion in March, well, we've got to do that distribution before that conversion. So, the reason you may run into this is scheduling and people not thinking about it. Because if you've got IRA 1 at your financial advisor's office, or you're talking to your financial planner who you're talking to all the time, and you've got IRA 2 at a bank you're dealing with and CDs, and then you've got IRA 3 at another bank, these might be on different schedules. The one that the financial planner has, hopefully they're thinking about what your needs are and what your total plan is, not just what they have to do. Where these folks at the other institutions might just say, hey, as long as we get it done by the end of the year, we're good. So we're going to put this on automatic distribution, which is really common, on 12/1/20 at the end of the year. Well, that could completely mess up your situation. So in this example, the total balances of and RMDs rounded up for each IRA are as follows. So we've got IRA 1, IRA 2, IRA 3, as you can see. And if you're just listening to us on the podcast, I know I'm showing a lot of information, so you may want to come back to the YouTube channel to be able to follow along. Arnold's total aggregated RMD is $42,081. He can split this up any way he chooses between his 3 IRAs. He must take the total amount before the end of the year. We know that. Prior to taking any distributions, Arnold tells his financial advisor that he would like to do a Roth conversion of IRA 1. Arnold must take the entire $42,081 before a Roth conversion can be processed with IRA 1 or any of his other IRAs. It's not good enough to only take the $4,951 RMD from IRA 1 and then subsequently do a conversion within the same IRA 1. So Arnold doesn't have to take the $42,000 out of IRA number 1. He can take it from any of them. He can, as I said before, he could take it from IRA number 2, IRA number 3, or a combination of all 3. But he he or you or anyone has to take the full RMD amount from one of the IRAs or a combined total of them before any Roth conversion is done. If Arnold completes a Roth conversion before he satisfies his entire $42,081 RMD for the year, whatever remained of his RMD before the conversion is considered an excess contribution in the Roth IRA and must be removed in addition to any earnings. For example, if Arnold took only the $4,951 RMD from IRA 1 and then did a $50,000 Roth conversion within that same IRA 1 or any of the others, he would have an excess contribution in the Roth IRA of $37,130. That's a big one. This represents what Arnold had remaining on his total aggregated RMD, $42,081 minus $4,951 equals $37,130. Arnold would then have to follow the excess contribution corrective measures. Again, sequencing matters. RMDs have always had to be taken before any Roth conversion. The difference now is that all of a person's total aggregated IRA RMDs must be withdrawn prior to a conversion, not just the RMD on the account being converted. Be careful here, as a new rule flies in the face of how many RMDs and conversions have been processed in the past. And that's true. So this is another important reason why it's important to stay up on these updates, to be involved with a group like this, the slot group, the Master Lead Advisor group. I don't know of any other group in the country or the world, for that matter, that's like that. So if you know of any, let me know. But as far as I know, it's only Ed's group. Okay, so what have we talked about here? So we talked about the aggregation rule. Now what we have left to talk about is qualified charitable distributions. Well, this is an easy one. Qualified charitable distributions, even though they can be done before RMD age, satisfy RMD, so they must be done before any Roth conversions. So you want to make sure you do your QCDs also before your Roth conversions, if you're considering both. All right. I don't see any questions. That covers RMDs and Roth conversions. Rules to know. There are probably other rules too that we haven't covered. This is education. You should keep yourself educated. Remember that you should not be receiving advice from anybody on the internet, including myself. Advice should be personalized and directed to you, considering your goals, issues, objectives, etc. But take advantage of the education you get on this channel, on the podcast, and others out there. Be careful where you get it. You know, I saw there was a guy I saw on Instagram, and he promotes himself as a previous financial advisor and asset manager, and he's absolutely being truthful, and he's got a lot of followers on his Instagram channel that I'm sure is making him a lot of money. But I was just curious after listening to him a couple of times at what his level of experience is, and I think he was a financial advisor for maybe a year, maybe just a little over a year. So I'm here to tell you, folks, you don't know much in the first year. You don't know much in the first 5 years. It depends on what you're doing. It takes a long time to really get comfortable. I'd say 5 years is a minimum amount. This is just my opinion. I can speak to it now, being in this industry for over 25 years or 24 years. But you got to be careful who you get your advice from, or even your education from. So that was good seeing you again. Just us, because we had a series of guests. I hope this information was helpful, and I look forward to seeing you next week. Take care. Have a great week.